All right, so welcome everyone. We are on Zoom. We have about 14 registrants, so we may see people pop in a little bit later. We're also streaming live on Facebook, so I will be going back and forth there just to see if we have any questions that pop up through Facebook later. So today we're actually talking about how to obtain home ownership here in Georgia. And with me today, I have Ms. Laura Jolin, who is with Cross Country Mortgage, and we'll hear more from her a little bit later. But to start, what I typically do is start with an introduction for myself, and then we'll go into the home buying process, and then we'll discuss lender options, which today we're focusing on 100% USDA loan, a USDA loan product. So we're going to kind of hone in on that today. We'll talk a little bit about credit, down payment assistance programs, and then we will open up for questions in the event that you all have some. So for those that are not familiar with me, my name is Kelly Adams. I'm actually a native of Atlanta. I'm a wife, and I have two, I'm going to choose my words wisely, two active kids, two boys. They're 10 and 6, and so we have a lot of fun with them. Nonetheless, I am a huge advocate for health and wellness. I love music. I cannot sing a lick, but I do love music. So I'm one of those people that regardless of what I'm doing, I'm listening to music. That's me. My interest for real estate actually began in 2006. I actually graduated undergraduate with a business degree with a focus in real estate. And if you're familiar at all with the market, you know that in 2007, 2008, the market was just plummeting. So naturally, I'm just like, okay, I'm fresh out of school. What can I do? So I went into post-secondary recruitment. So I've always recruited for colleges. I always recruited for education for college. And so in 2017, about 10 years into that, I decided to go back and get my real estate license and kind of pursue what I really wanted to pursue in the beginning. So here I am. Since 2018, I have been practicing real estate as a licensed realtor. So I'm in year 6 now, and it is wonderful. It has been life-changing for not only me, but for my family, and for all of the clients that I've been able to impact. So I'm huge on education, hence my webinars. I like to educate future homeowners, current homeowners that are looking to either downsize or to get a larger home, maybe because their, families are growing, whatever the case may be. I'm always about educating because it's likely not going to be the only time that you purchase a house this one time with me. I want you to be able to purchase again, whether in another state or maybe for like an investment property, you'll already know what you'll need to do. So I like to empower my clients, hence this webinar. So who in here is a first-time home buyer? Who will be a first-time home buyer this year? We're going to claim this year. Who's going to be a first-time home buyer?
This year, I am Pamela Evans.
Okay, cool. Miss Pamela, she's going to be a first-time home buyer. Anybody else? All right, so Miss Pamela, we have one first-time home buyer, and congratulations to you on making that commitment to yourself and vocally here with us as well. This question is for anybody. What made you click on this link to register today? Why do you want to purchase a home? What makes you want to purchase a home? And you can utilize the chat feature. You can open up your mic. This is not formal.
Pamela Evans again. So for me, it's because of family obligations. My mother just passed away, and we have a special needs brother that I have to take care of now, even though I've already raised my family and all. But I now have a new family because he has
Yeah.
special needs. So, he has, there's a lot of things that he needs, and I live in a small apartment, so I need a bigger space
You
for the
need the
both of
room.
us. Hmm.
Wonderful. Well, I'm sorry to hear about your mom,
Oh,
and
thank you.
I'm glad that you're there to be there for your brother in this time because he definitely needs you, obviously. So
Hmm.
great job stepping up in that regard.
Thank you.
Anybody else? Why do you want to purchase? Miss Pam needs more space. Miss Kimberly, Lakia.
I'm a first time home buyer as well. I'm not sure. I was trying to figure out my mic thing here.
Oh, good. Yeah, you got it worked out. So first time home buyer, any particular reason why you want to purchase?
I actually would like to maybe use it as my first investment property as well for because I'm looking to do so the first time I buy a home, I'd like to find something that's a multifamily, fourplex or more.
Mhm,
Yeah, fourplex or more.
mhm.
That way I can live in the home with my family and then use the other the
Yeah,
others to, rent out or do what I will, but I like to continue to rinse and repeat that process. But I like that to be the first time I buy a home.
that's wonderful. That's awesome. And that's really good. I encourage anyone that can to purchase duplex, triplex, quad, or more if feasible. A couple of things, and Laura and I, we've worked with a young lady, I think mid-20s or early 20s that purchased a duplex, lived in one side, currently lives in one side, even still, and she leases the other side that pretty much pays for the
Yeah.
entire, you know, duplex. So it's definitely possible. And I really like that approach. So a couple of other reasons why people choose to decide to purchase a home is obviously a place to call home and a place that is yours, somewhere that um, that you're not paying, someone else to stay there. It's you're calling it home, but you don't own that particular home. So you're looking for ownership. You're also looking for stability. I do have some moms that come and are tired of just, having to uproot their kids and take them to different, locations just because maybe, the homeowner decides to sell the property or maybe rent goes up and it's out of their reach financially. And then just like Kimberly, she's talking about investment. Every home is an investment, regardless of how we look at it. So homeownership is definitely an investment. So what are some benefits to homeownership? Obviously, you're able to stabilize most of your costs, especially if you have a fixed rate. The only thing, and I always like to tell my homeowners or future homeowners this, the only thing that can typically change your mortgage is going to be, as long as you do have a fixed rate, is your homeowner's insurance. If you happen to change your homeowner's insurance policy and perhaps it goes up or down, that can change your overall mortgage payment and also your property taxes. And that's kind of a catch-22 because obviously we want our values to go up in our properties, but a lot of times when your value goes up, that also means your property taxes go up. So those are the only two things that typically can change your mortgage payments. But otherwise, your principal and interest does remain the same as long as you do have a fixed rate. Equity is another benefit. So we hear people talk about equity all the time. Obviously, equity can be great as long as it is positive equity. Positive equity meaning, and for those that are not familiar with what equity is in a property, say for instance, you purchase a home and it's $350,000 and 5 years go by, you now owe 300,000 on the property and maybe the property is worth $400,000 now. The difference between what your property is worth in this example is $400,000. And then in the same example, you're now owing $300,000 on the property. So now the difference between what you owe and what your home is worth is $100,000. And so that's your equity. And a lot of times you can tap into your equity without having to sell your property. which, you know, there's other loan products you could, you know, do to utilize that, maybe a home equity line of credit, maybe refinancing your property and getting that cash out. So, and people use it for, you know, various different things. Maybe you need to do some updates on the property. Maybe, you know, you have a business you'd like to start. Maybe you need it for education for one of your children, however you decide to utilize that. There's also tax benefits associated with home ownership. So when you do own a property, you are paying your interest. You can write that interest off every year when you file your taxes, and also your property taxes, you can write those off as well. Stability again. So not only do you stabilize your costs by having a mortgage, but you also stop moving. You know that you have a place for, you know, you have a 30-year mortgage more than likely, and the average person typically stays in their home between 5 and 10 years before either upsizing or downsizing. So hopefully you'll have the ability to, you know, gain some true equity there. And a lot of my current clients, what they do is they use their current homes to invest in other properties. So they utilize that equity that they built in their current properties to actually invest in another. So, you know, whether that be a condo or a townhome or, you know, some type of vacation property, you do have that option. So here's a couple things. Before we actually start house hunting, what I typically do is I'll send you to a lender to get pre-approved. That lender wants to talk to you about credit. They also want to talk to you about your income, things of that nature, to see how much you are eligible to pay, or how much you're eligible to pay for a property, I'll say. From there, we discuss your specifications. So we talk about what you're looking for in a property. What areas are you looking for? Are you looking to move in Stone Mountain? Are you looking to move in Fayetteville? Are you looking to move to Carrollton? I mean, there's so many different places in the Atlanta area that we kind of have to hone in on an area. It usually is best if we do have at least the, you know, area of, you know, whether that's south, southwest, you know, east, north, wherever, kind of give us an idea of where you would like to be. And then we talk about the home specifications, like how many bedrooms, baths, you know, are you looking for garage? Are you looking for open concept? You know, do you prefer front yard, backyard? All those things matter. So from there, we also talk about securing upfront costs. And so with those, upfront costs are typically going to be your earnest money deposit, which is your good faith deposit. So your earnest money is typically due when you submit your offer on your property. So we're going to keep the same example going throughout the entire webinar. Let's say you are, you know, interested in a property and it's $350,000. Your earnest money is typically 1% of the sales price of the home. So then that earnest money would be $3,500. And so earnest money is typically held by your closing attorney. And so the closing attorney holds that, and they basically, the great thing about earnest money is that it comes back to you at closing. So on closing day, you get a credit back to you for that 1%. Very seldom is your earnest money more than 1%. I mean, if you really like a property and there's a lot of people, you know, putting bids on the property, then you may want to make your offer a little bit different. Maybe you offer $4,000 earnest money, or sometimes in the event that you do have a new construction property that you're interested in, sometimes they have their own set earnest money deposit. So that can vary, but for the most part, it is 1%. Earnest money is a good faith deposit. Just as a recap, it's the 1% that you put down when you are putting an offer in on a property. Earnest money comes back to you at closing. Upfront costs. So that's your first, being earnest money. Your second is your home inspection, which is not mandatory, but it is highly recommended. Home inspections can save you a ton in the long run. Home inspections run about $400, give or take. But if your property is under 4,000 square feet, you should anticipate around $400 for your inspection. So what does the inspection do? What does the inspector do? The inspector comes out, they are looking for defects in the property. So not cosmetic things, not, chips and paint or, a door off the hinges, things like that. Those are things that do need to be addressed, but the inspector is looking, for things that make the home like hazardous, like roof issues, leaks, plumbing issues, electrical issues, things that we're not seeing because we're not going on top of a roof. We're not going in crawl spaces. We're not going up an attic. I'm not. And most times my female clients aren't, but some male clients, they will do that. Things like that. Now, home inspections, they are, just as a recap, home inspections are not mandatory, but they're highly recommended. They're around $400, and it does depend on the size of the property. So anything over 4,000 square feet, you can anticipate a more hefty, price for your inspection. Now, home appraisals, as long as you are getting a mortgage, is mandatory. So if you're paying cash for a property, then you do not have to have a mortgage, because obviously you're paying cash, so you don't need a mortgage. So you don't have to have an appraisal. But if you are utilizing a mortgage company to fund your purchase for your property, a home appraisal is mandatory. What is a home appraisal? That is going to be where an appraiser comes out to the property and they basically assess the property's value. So they're seeing where the property's located, what updates have been done to the house. They're looking at recently sold homes in the area, which we call comp homes. And then they determine what the value of that home is. This is important because if you have a property under contract and it's under contract for $350,000, and your appraiser comes in and they're like, well, we see the contract has it for $350,000, but based on, these evaluations that we've done, the property is actually worth $325,000. Guess what? Your lender is not going to lend you $350,000. How much are they going to lend you? They're going to lend you $325,000. So in that case, me as your agent, I would go back to the listing agent and say, hey, here's a copy of the appraisal. Here's a amendment to address the sales price, to reduce the sales price. And then we reduce the sales price based on what the appraiser has come back with. So it's important because you don't want to overpay for a property either. So I've given you a lot, upfront costs, and what else did we cover just before that? Equity and things like that. So any questions here, I'm going to just take a pause. Any questions on earnest money, home inspections, appraisals? Does anyone have any questions based on the difference of the two? Anything you've heard about them that you kind of want clarification on? And I'm going to check Facebook too. If you don't want to unmute, you can also throw your question in.
This is Lakia. I have a question.
Yes.
So if you put in a bid and it comes back less than, are you able to retract your bid, or do they have to adjust the bid, or how does that work?
So in my experience, and I've waited a while to get this done, but in my experience, I've always gotten the home price reduced. So with the backing of the appraisal, we would then get the home price reduced. So we wouldn't have to back out of the current contract. We would just amend the contract to the new sales price if it is lower. I've also had it where the appraisal came in over. So if it comes in over, we don't do anything. Guess what? You just move in with equity. Does that answer your question?
Yes, it does. Thank you.
Okay. But it does take the cooperation of the seller. The seller has to be willing to reduce the sales price. So if they don't, then the worst case scenario in that case, let's say they do not budge. They're like, no, I want this $350. I don't care what the appraisal says. We're going to sell at $350. Well, then you should have an appraisal contingency. And that appraisal contingency would protect your earnest money during that time. So if the seller will not budge and they will not accept anything less than that 350, and you're not willing to pay the balance between that 325 and 350, you can terminate the contract. And pending you do have an appraisal contingency in place, which you should, then you get your earnest money back and you terminate the contract. So that's absolute worst case. But most times, if you're approved, that seller does not want to put that home back on the market. They're like, no, I have an approved buyer. I have a legitimate appraisal. Let me just get to this closing table. Usually that's the sentiments, but I do have to give you both options because that is a possibility.
Okay, that makes sense. Thank you.
Okay. All right, I don't see any more questions on Facebook either. So we're gonna keep moving. If you have any other questions, just feel free to chime in. All right, so once we found your property, we make an offer, we include your earnest money. We have what we call negotiations. So maybe your offer isn't accepted straight up. Maybe they counter your offer. Maybe they want a earlier closing date. Maybe they want more earnest money down. Maybe they don't like your sales price. Maybe they want a higher sales price. Maybe you underbid, so we go back and forth and eventually we have an accepted offer. Once we have an accepted offer, we have 7 days of due diligence to make sure this is the house for you. Typically, this is 7 days. I've done due diligence as little as 3 days. I've done due diligence as many as 10 days. It really just depends on how aggressive we had to be with the offer. But typically it's going to be about 5 to 7 days. Okay. All right. Okay, so I just got a notification that we may have a question on earnest money here. I didn't see it. Let me go. Hold on. I don't see the question. Oh, I don't see a question. Okay, Gwen, I got your text, but I don't see the questions. So, oh, yeah, I see it. Hold on. Okay, had the opportunity many years ago. Nope, that's not her. Oh, I don't see the earnest money question though. Okay. Okay. All right. So someone asked, can you lose your earnest money? And the answer is yes, you can lose your earnest money. So you can lose your earnest money in many different ways. So I'll start by saying this. So in due diligence, you can terminate your contract for whatever reason you want to, as long as you're in your due diligence period. So it's important to know when your due diligence starts so that you'll know when it ends. So for instance, let's say we had a contract that we had accepted today, and we have a 7-day due diligence. That means we have 7 days until that 7th day at 11:59 that day. So say, for instance, we had it accepted today. We have Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday. So we have until next Sunday, 7 days, 11:59 next Sunday before you could terminate for any reason. Now, during this time, it's important that you have all of your inspections done during that time period. There's typically one inspection that you want, which is the home inspection. That home inspection is, you hire the right person, is thorough. It's going to be about 2 or 3 hours for the home inspection. Once the home inspection is complete, there may be additional inspections that you need. For instance, maybe an HVAC is old and you may need an HVAC professional to come out and see if it's fully functioning. Maybe you need an expert roofer to come out because there are some shingles missing, or, you know, there's some question marks around some things that maybe beams in the attic or foundational issues. Like if you need specific people to come out afterwards and you need that additional time, it's always good to have your inspection as early as possible. That way, if you do need additional professionals to come out, you have the time for them to come out. So within your due diligence, you cannot lose your earnest money. So same example, $350,000 home, you put your earnest money up, that's $3,500. And during your due diligence, you have an inspection done, you know, your home passes inspection, you get through due diligence. After due diligence, if you terminate your contract, you can lose your earnest money if you just say you don't want the house. Like if you just wake up and you're just like, I don't want the house anymore, I don't like it for whatever reason, you can lose your earnest money. However, if it's for a financial reason, meaning if your loan is not approved, and you are out and you're still within your financial contingency, then you can retain your earnest money if your contract terminates outside of those 7 days. So I give you an example. Let's say you put your earnest money down on the property, you have your inspection, you pass the due diligence days, and let's say by day 10, your loan goes through underwriting and they deny your loan. As long as you're still within your finance contingency, you can terminate that contract and you can retain your earnest money. If you're outside of your finance contingency, or if your agent does not have a finance contingency in place for you and you terminate outside of your due diligence, you will lose your earnest money. So there are ways you can lose it. But that's why it's important to have an agent that is aware of all of these dates so that we keep everything in line. And I hope that answers your question, whoever that was about the earnest money. So, all right. So you make an offer, you submit your earnest money, you have negotiations, you have an accepted offer, you go through due diligence. During due diligence, this is where you have your inspection. You determine who's gonna fix repairs. Typically sellers right now, they are fixing stuff because they want to sell, and it's not a true seller's market. It's not a true buyer's market. I feel like we're kind of in between to where, you know, there's give and take on both ends to make the transaction work. But more sellers are willing to fix repairs. What happens if your seller doesn't have money? Because a lot of times sellers are selling because they need the money. So if your seller has things wrong with the property that you're adamant that needs to be fixed, sometimes they don't have those funds in place. So in the event that that does happen, there are other alternatives. The seller can pay a contractor at closing from their proceeds to have that specific work done. That's a possibility. Or they can, in lieu of making those repairs, they can give you additional, you know, closing credit, which lessens the amount that you have to bring. So say, for instance, there's a few shingles that need to be replaced, or, well, honestly, that would have to be replaced before you close. Let's say there are some, maybe the HVAC is old and you don't even want to be bothered with the HVAC. You're just like, I would much rather someone, you know, I would just much rather have something fixed on the HVAC, or, you know, something like that, but maybe they can't afford to pay for it. So they give you a credit for $2,000. Okay, cool. They give you a credit. That's $2,000 less dollars you have to bring to closing. So then you have those extra $2,000 that you can do what you need to do with. That is an option. All right. From there, you just want to maintain contact with your agent and with your lender. At that point, you're more so in contact with the lender at this time, because at that point, they're getting all their documents in, they're submitting your file to underwriting. You know, there's conditions that need to be met, things of that nature. So a lot of that back and forth happens with the lender and the buyer. All right, so I did a lot of rambling. So here is just an overall picture of what you can anticipate if your price point is $300,000. So in a snapshot, everything that we've gone over so far, your sales price is $300,000. Your earnest money, which is 1% of the sales price, is $3,000, right? Boom, you see that here. Inspection, $400. And I forgot to mention appraisals. They're going to run about $550. It depends on the lender, but it could be more, it could be less. I've seen them $450, I've seen them $650, I've seen them $750. It just depends. But $550 is on average what I see most frequently. So upfront costs, you're looking at a $300,000 home. This is what you can anticipate upfront. Earnest money $3,000, inspection $400. Home appraisal $550. That gives you $3,950 up front. Okay. Now you talk about down payment. Today we're talking about a USDA 100% loan, which means anytime you see 100%, that means there's no down payment. In a traditional purchase, you're going to pay 3.5% down minimally, and that's with the FHA loan. So if this was a traditional FHA loan, your down payment would be $10,500. If you're going USDA 100%, then this would be zero because you wouldn't have a down payment. Closing costs are usually going to be about 3 to 4% of the sales price of your home. Closing costs and down payment is different, and we're going to go over that in the next slide, what the difference is. So total, if you're looking at making your own down payment and paying your own closing costs, you're looking at $20,500 for both of those combined on average, because it could be less, it could be more. Remember, your earnest money comes back to you at closing. That's just $3,000 coming back as a credit. Let's say the seller contributes $3,000 towards your closing costs. That means your final cash to close is around $14,500. Okay. This is with you making your own down payment. So keep that in mind. All right, so where can your down payment come from? Because a lot of people looking like, I don't know about that $10,500. If you don't qualify for USDA, or maybe you're not willing to move to an area that is in a USDA eligible area, maybe you prefer to be closer into the city, then your down payment can come from your 401k. It can come from a gift from a family member, maybe, you know, mom or dad or your aunt or your son wants to gift you, you know, your down payment. They can do that. Obviously you can save and budget. It just takes a little longer. But then there's also USDA. I'm sorry. Well, there is USDA, but I meant you could use a down payment assistance program. So we do have down payment assistance. There's also USDA. So we're going to talk about both of those today. All right, so the difference in closing costs and down payment. So down payment goes towards your loan. So say, for instance, using that same example, $350,000, $350,000, let me see, because that's going to be different. 350 times 3.5%, that down payment is $12,250. So your down payment actually goes towards your loan. So your loan amount would then be $337,750. So that basically shows a good faith towards, okay, here, you know, I'm taking out a $350,000 loan, but here's this down. So you actually, you know, it goes towards your loan. Closing costs does not go towards your loan. So these are fees that you pay the closing attorney, your lender, any miscellaneous admin fees, filing fees for the county, different things like that. That's what the closing costs are for. Now, when you're buying, that's typically your fee, but the sellers sometimes, a lot of times they do contribute. Builders, if you're buying new construction, they do contribute, or sometimes they pay the entire closing. So that usually leaves you with only your down payment. So got a few options there. Closing is the buyer's responsibility. Sellers can contribute. So it's the same thing I just mentioned. And then closing costs are typically between 3 and 4% of the sales price of your home. So Any questions here, just dealing with closing costs, down payment, anything dealing with the financial screenshot that we went over? And you can unmute or you can text your question. Okay, I think we. Okay, so we do have a question about earnest money and new construction. So, new construction, sometimes, most times they have their own down payment. I'm not sorry, not down payment. They have their own earnest money amount. So regardless of the price of the home, I've sold a $350,000 home, new construction, where their earnest money is $7,500. So it really just depends on the builder and the area and what their specific requirements are. I've also sold $350,000 homes with $1,000 earnest money or $500 dollar earnest money. It means been a couple years ago, but it's been possible. So the builder would determine what their earnest money is. But when you're dealing with new construction, they have their own contract. So it's really important to have an agent representing you to make sure that you fully understand what that contract is that the builder has. All right, so a couple questions here. How long does it take to buy a home? From start to finish. So one of the first questions is, how long does it take? Oh, you know what? Yeah, how long does it take to find a real estate agent? And it really just depends on how you're being referred an agent. Some people find agents through Google, some through like reputable, family and friends that have, relationships with agents. So it could vary from a day to a few weeks, just depending on, how you're referred. How long does it take to get approved for a mortgage? Now, this is different from a pre-approval. Pre-approval, you can likely get a pre-approval in a day. Pre-approval is basically saying, hey, based on your credit, based on your income, based on your debt, you're approved for this amount. You're pre-approved for this amount. But to have a full approval, it could take about 2 weeks. And what happens is your file goes through underwriting. Underwriting is like combing through your file to make sure you are worthy of this loan. So they are dotting every I, they're crossing every T, and they will be a thorn in your side for about 2 weeks, just asking you for sometimes the same document, what feels like, or, just what you feel like picking on you, but they're really not. They do it to everybody. So just kind of be prepared for that. How long does it take for a showing? For me, maybe about 15 or 30 minutes. I have gone to homes that we don't even go in because we were bamboozled. Maybe the photos were just beautiful and we get to the property and we're like, this is not that home. And that's going to happen. So be prepared for that. Or sometimes you like the house, but you really don't like the area. So if that's the case, we can just go to the next home. We don't even have to go in. But you're going to see some homes that you just do not want to leave, and that's okay. Well, it's not okay. We do have to leave, but we may be there for a little while, while you scope out where you're going to put this couch, where you're going to put your TV, how your bed going to fit. Like, we going to do all of that. So, how long does it take for an offer to be accepted? This, on here, I have anywhere between a day or 3 days. Typically, I give people 24 hours to respond to an offer because it really shouldn't take very long. But sometimes we have sellers that are traveling. Maybe they're in a different country. Maybe they're in a different time zone. So we do have, those certain times where it could take longer than a day to find out, but typically about 24 hours. So how long does a home inspection take? Home inspections, I think I mentioned this earlier, but they could take anywhere between 2 to 3 hours to complete. And so with home inspections, you don't have to go to them, but you can, or you can just, go toward the latter part of the home inspection. So if it starts at 11, then you could kind of estimate it'll probably wrap up around 1 or 2 o'clock. So you may want to go around like 12:30 to talk to the inspector and kind of see some of the things that they want to point out to you. Appraisals take a little bit longer. They're going to be anywhere between a week or two, just depending on how backed up that particular appraiser is. And the reason being is that their process is a little bit longer. So opposed to them just coming out and looking at the property and just coming up with some numbers, it's not that easy. They actually have to go back, go to their office and have these 3 different approaches just based on what other homes have sold for. And they have different formulas and things. So they have a whole thing that they go through that takes a little bit longer. And then on average, it's going to take about 30 to 40 days to close you out. So once you actually find a house, get it under contract, expect to close in about 30 to 45 days. And so that's going to vary based on how quickly you're able to get things done, get those items submitted, get your paperwork in just in a timely manner. You just want to be really, really efficient with getting those things in as soon as those items are being asked of you. Couple other things, buyer dues. You want to know your credit score. That is like the number one thing. You want to know what your credit score is. You also want to shop lenders. What a lot of people don't know is when you are shopping for a loan, you typically have 3 credit pools specifically for a mortgage within about a 14-day window that you're able to have 3 different lenders to pull, but it has to be for a mortgage before you're actually like anything over those 3, you're going to, have, it's going to be reflected on your credit. So you know how you don't want, 1 or 2 or 3 people pulling your credit because you're like, it's going to ding me. It's going to, show that it's probably going to show, but it should only ding your credit as like 1 credit pull. So it won't be like 2 points each time. It should be like 2 or 3 points just one time, if that makes sense. So, but the key is to do it within that 2-week window. Also, you want to understand the process. So this is why you're here. You want to understand the whole process from start to finish, and you definitely want to work with a skilled realtor. What you don't want to do, you do not want to change jobs. You do not want to buy a car. You do not want to be a co-signer on anything while you're under contract. You don't want to do anything. All you want to do is pay your normal bills, go to work, go home, pay your normal bills, go to work, go home. That's it. Nothing new, nothing different. Your best friend call you, your kid call you, mom, dad, I need this. You got to wait till after I close on my house. That's it. So you don't want to apply for any new credit cards. You don't want to do anything out of the norm. Just do your same routine until you close. And after that, it's on you. So I'm going to pause here before Ms. Laura comes on and talks about lending. That's the home buying process from me. Any questions on the buyer do's and don'ts? Down payment, closing costs, anything? Okay, I'm getting some good questions on Facebook. So I have one question that says, is there a cap to the value of the home you can purchase? So Laura, I'll wait until you go over USDA for that. And then I have another question about which areas or counties is the no down payment home? So I think we're going to touch on that too. Okay. All right. So for people that's here in the webinar, does anyone have any questions based on what we've gone over so far? Okay. So I'm going to introduce Ms. Laura. Laura, Jolyn, and I have been working together for almost 4 years. I actually met Laura because she represented a buyer for a listing that I had back in 2020 for a property in Austell. Laura, you probably don't even remember that now, but I called her and she was just like Johnny on the spot with like with answers for all the questions that I had. We closed on time. I mean, it was not like pulling teeth to get information that she could share. It was just easy. And I'm just like, okay, I need a lender like this. And so we've done a lot of different loans. She saved a lot of deals for me. She is very knowledgeable. Her background is just impeccable. She thinks like the underwriters, which is helpful. So today I have Laura on here to talk about, she's with Cross Country Mortgage, by the way, and we're going to talk specifically with her. She's going to be covering USDA loans. And so with USDA, I think I'm going to stop sharing because I have a flyer that I want to share for her. With USDA, I think a lot of people think you have to live in like a super rural area, but you don't. And so we're going to be talking about the USDA affordability today. And Laura, the floor is yours. I'm about to get your flyer pulled up.
Excuse me. Hi, everyone. I don't know if they can hear me.
I can, so I'm pretty sure they can.
Oh, okay.
Yes, I hear her.
Oh, okay. My name is Laura Jolin. I'm with Cross Country Mortgage, and I have been a lender almost 40 years now, which is a long time. As far as USDA loans are concerned, really in the state of Georgia, there's no maximum loan amount. They do have limits on debt to income ratios. For example, USDA, and I wish they would change this because this becomes a problem. USDA will not go over 45% total debt ratio. And what that is, it's your new house payment plus all of your debt. Now, I'm not talking utilities and things like that. I'm talking car payments, student loans, installment loans, credit cards, things like that. That total is divided by your total monthly gross income, and it cannot exceed 45%. So we really have to stay in ratio there. That's one of the caveats with a USDA loan. USDA is the U.S. Department of Agriculture. And when a lot of people think about a USDA loan, they think you have to be in East Egypt somewhere, but you really don't. There are numerous pockets. Well, number one, you cannot be within city limits. So if you want a USDA loan in downtown Atlanta, it's not going to happen. But you don't have to be on excessive acreage, out in the middle of nowhere. And you can always, if you find a home that you like, and of course, Kelly can do this as well, but you can Google USDA property eligibility and type in an address, and it'll tell you whether or not that property is in a USDA zone. Now, it is 100% financing, so no out of pocket, no down payment. The seller can pay up to 6% in closing costs, which can be, quite a bit. So as an example, if you're purchasing a $350,000 house, the seller can pay up to $21,000 towards closing costs, prepaids, which are your prepaid interest, your homeowner's insurance, which is paid 1 year up front, just like car insurance. You pay it in advance and not backwards. Let's see, prepaid interest, taxes, and I'm just kind of drawing a blank here. I'm sorry. Prepaid taxes and insurance is what that is. Typically, we see the sellers paying, roughly 3 to 4% on a good day. And the good thing about a USDA loan, for example, your earnest money is applied towards whatever you need out of pocket at closing. And if the home, and again, if you're buying a $350,000 house, but it appraised for $360,000, and your out of pocket money is roughly $2,000. Well, that $2,000 can be financed into the house. So essentially you'd be buying a house, virtually for nothing, except for the earnest money that you put down and your appraisal fee, of course. But if the numbers work out correctly, you can always get your earnest money back and your appraisal fee back at closing if the home appraises higher than the sales price.
And this is
That-
on a USDA loan only that this would apply, correct?
Correct.
Okay.
That's correct. We talked about, the debt ratio, which really, it limits you somewhat, to stay within that 45% debt ratio. USDA has a 1% funding fee. That's their version of mortgage insurance, and that's also financed into the loan. They have a monthly mortgage insurance, which is very low. It's 0.35 of the base loan amount divided by 12. That's the lowest mortgage insurance on any mortgage product. It's with the USDA loan. As far as credit scores are concerned, we can go as low as 580 on a credit score. And there's two findings that we get when we run your file through GUS. It's GUS, it's a government underwriting system. We can get an accept, which is great. We're moving forward. Everything is fine. Or we get a refer. If we get a refer on the file, it doesn't mean that you're not eligible. It means we have to stay within a certain ratio. So for example, on a refer, your housing payment cannot exceed 29% of your total monthly gross income. And your total debt ratio cannot exceed 41% of your monthly gross income. Typically, there's no reserve requirements, and reserves are their funds left over after all is said and done. And it can be checking, savings, IRA, 401k, anything like that. It's not typically a requirement on a USDA loan. USDA is a double underwrite. It goes through our underwriters, and then it's sent electronically to USDA for the guarantee. And typically when it goes to USDA, they're essentially just underwriting the credit portion of it. They issue the guarantee, and then we go to the closing table. It's one of the simplest loans that we have as far as the 100% financing. Do you have any questions on that?
I do.
Okay.
So using the example of the $350,000 home price
Yes.
and using the USDA 100% loan, could you
Mhm.
give an approximate monthly payment?
Sure.
Okay.
Give me just a second here. Okay, so the funding fee would be roughly $3,500. That's financed into the loan. And I'm going to use an average interest rate. And no matter what type of loan you're getting, the rates, discount points, that type of thing, it's based on credit scores. So I'm going to use an average of 6.5. And I'm going to give you the base. All right. The base payment, principal and interest is what it's called, is $22.34 and 36 cents. The monthly funding fee for USDA is $103.10. I estimate homeowners insurance, and all of this is included in your monthly payment, to be $90. And when I'm just working up a figure for someone, I typically take 1% of the sales price for estimated property taxes, unless they give me an address, and then I can pull the actual tax bill. So 1% would be $291.67. So let me just add this up for you. 2719.13. And that's with, of course, estimated taxes and insurance. $2,719.13 based on a $350 sales price.
What happened to the 2234? Where did that go?
I'm sorry?
Didn't you say initially $2,234?
Correct. That's principal and interest.
Oh, and all these other things are in addition. I'm sorry. I guess
Correct.
I, okay.
So your taxes and your insurance, they're escrowed. So for
Okay.
example, if you close this month, next year when your taxes and insurance become due, they're
Uh-huh.
automatically paid.
Okay.
So you don't have to worry
And
about paying that out of pocket.
uh-huh. And that lasts for, what is that, until something about 80% of your loan or something like that?
No, that would be
Mm.
on a conventional loan, FHA loan, that type of thing. The mortgage, the monthly mortgage insurance, it stays on the loan unless you refinance. If you're at an 80% loan to value, you can refinance to a conventional loan.
Okay. And for property taxes, is the homestead exemption, is that still around, or does it apply,
Oh,
or?
yes. Yes. After closing, you would take your deed and your settlement statement to the tax assessor's office in whatever county you're in, and you apply for homestead. And a lot of counties, you can just do it online. And then you get a tax break. But now you're not going to get that tax break until the following year when the home is reassessed.
Okay. Thank you.
So what are like can you just give us like the specific requirements of being approved for this USDA loan? Like what do you have to make sure that you have before you go ahead and see if you can get approved for it? Like what
Okay.
should be ready available?
Well, first of all, you have to have at least a 580 credit score. And you have to have, of course, sufficient income to justify the loan. Now, USDA does require tax returns. They require 2 years of tax returns to verify income and whatnot, 1 month of recent pay stubs, 1 month of bank statements, 2 years of tax returns along with W-2s, driver's license, social security card. If you receive any other additional income, for example, child support, annuity, anything like that, we verify that as well. And as long as you don't exceed a loan, which is an approvable loan, well, a refer is approvable as well. On an accept, we can't exceed the 45% total debt ratio. And on a refer, we can't exceed 41 total. So let me give you an example. Say your monthly gross income is, I don't know, 4,500, and we got a refer on your loan. So your housing payment can't exceed 29% of your $4,500 a month income. So your mortgage could not exceed 1,305, 1,305. That would be 29%. And that would be the total mortgage, not just the principal and interest. It would be taxes, insurance, the funding fee, all of it together.
And what price home did you say that would be on?
The 1,300,
Uh-huh.
I just used 4,500 as monthly gross income to give you an
Okay.
example of what the payment, what your mortgage payment could not exceed, being 29% of your income. But if we get an accept on the loan, then, and if your income is 4,500, we can't exceed, well, USDA doesn't allow it, 45% total debt ratio. So your housing payment and whatever debt you're carrying could not exceed $2,025. So all of this is based on what your monthly gross income is. Now, another thing with USDA, they count all household income. For example, if you were applying for this loan and you were going to be the only one on this loan, but you're married, your husband works, but he's not on the loan, they're going to verify his income as well. If you have grandma living with you and she gets Social Security, they're going to count that as well. Now, income limits are based on family size. And I believe that just recently increased to 109,000. But let me just verify that real quick. Bear with me, I'm sorry, just a second. All right, that did go up, yes. It's $110,650 gross income per year. And that's for a family size of 4 or more. If you have 5+ people, then it's $146,050 annually. Also with USDA, if you have children and you pay daycare, you get a credit for that. If you have somebody living with you that has any type of a disability and they receive SSI, Social Security Disability Benefit, anything like that, you get credit for that as well. So these credits, what they do, for example, if you're slightly over income, just based on gross income, these credits, childcare, elderly, disabilities, that type of thing, you get X amount of dollars off your gross annual income. So that would bring you back down into the income guidelines. Does that make sense?
Yes.
Okay. Overall, it's a very easy program. It's easy to qualify for. The home just has to be in a USDA zone. And what I tell people, you don't have to be in Cowtown, but you can't be downtown. You can be on the outskirts.
So that
So
brings
how-
up a good point. As you're, I'm sorry to cut you off. I think that was it Pamela?
It was, but it's okay. I'm sure
Okay.
you.
Okay, I'm sorry. I'm gonna just show you guys right now how so let's say you're on Zillow, you're on Realtor.com, and let me see. All right. I just want to show you the website and how easy it is to find the property and just to see if it's located in a USDA eligible. So eligible area. So let me share my screen with you. Hold on one second. And as I'm doing this, Pamela, you're free to talk.
Oh, I think you're going to answer my question with this slide or with this website.
All right, so USDA eligibility, just type in USDA eligibility map. And as you can see here, the link comes up. It should be the very first one, especially if you're in Google. So if you hit USDA's eligibility map, you click that. And then you accept this disclaimer. And then you type in a property address here. So is anyone looking at a property that they think may be USDA eligible? If not, let me see if I can find one. Now, Pamela, are you in Georgia?
Yes.
Okay. So for those of you that are in Georgia, because randomly I do get people from like different states that register for these webinars, but for Georgia, based on my experience, some of the USDA eligible pockets are going to be like in Henry County, like pockets of like Hampton, McDonough, Locust Grove. And then if you're looking like east, that would be like Conyers, Covington, Monroe, kind of like that way. And then if you're going west, that would be like Carrollton, Villa Rica, Paulding counties. And then honestly, Laura and I were talking this, I think it was either this week or last week, we were talking about, there's actually a pocket in Fulton County. That is
Right.
Palmetto, Georgia.
Right.
Yeah. So those are just some that you can kind of think about. Let me see if I can find an address for you, and just so you
What
can see.
about north? What about north? 85,
North,
75 north? Uh-huh.
yeah, it would have to be past like Gwinnett, honestly, because Gwinnett is not even, I haven't seen any in Gwinnett.
And what about on
No,
the 75 side, north?
I haven't seen any in Woodstock. I mean, it would have to be like maybe like Cartersville, like maybe.
Hall County
Uh-huh.
is eligible, and of course you go further north.
That's like Gainesville, correct? Hall County?
Yes, Hall County's Gainesville.
Okay, thank you.
So you plop an address in here. I was hoping I could get an address. Did someone put one in here? No.
Yeah, I'm trying to pull up the one I just did on that.
Let me see
Oh,
if
I
I
have it right here.
okay.
And this one, I was actually surprised by this one.
You have the address, you ready for it?
I'm pulling it up.
Someone had a question on Facebook. Is this only for first-time home buyers?
No, and another thing about USDA, for example, if you had another home and you had an FHA loan, but now you found another home and you want to go USDA, you
Mhm.
can retain a home. You can keep your current home and still buy another home as long as you qualify for it. The only thing you can't do, and obviously if people are going to retain a home, they're going to use it as a rental property or whatever the case may be,
Mhm.
we cannot offset it with rent. So you would have to qualify for both payments.
Got it. So your income has to be up there.
Right.
Got it.
So, okay, type in this one, Kelly, and then they can see how it comes up.
Mhm.
It's 8205
8205.
Wilkerson Mill Road.
Is it mill separate?
Yes, 2 words. Road,
Oh, okay. Road. Mhm.
Palmetto.
Is it two O's?
Yes.
I mean, two T's?
No. Yes, 2 T's.
Oh,
1
man.
L, 2 T's.
Okay. And
And
what?
that's it.
Okay. And then I just hit go. And then as you can see here, it says this address is located in an eligible area. And it will be green. If it weren't, it would be red, and it would say that it's not located in a USDA eligible. Yeah.
Right. So there are pockets all over the place. Sonoya, there's pockets. Noonan has pockets.
Yeah.
There's several. This one actually surprised me.
Yeah. And if you look on this map, South Fulton Parkway is right here. Like that's not far from me at all. Chattahoochee Hills not far from me at all. And Cascade Palmetto is not, like it's 15, 20 minutes down the road. And this is USDA eligible. That's wonderful.
Yeah, I was surprised by that.
So awesome. I just wanted to share that because I get that question a lot.
But
All
it's
right.
easy to look up.
Yeah, it is. That's why I wanted to do the Google way, but I will email everyone that registered with a copy of the link and a replay of this webinar too. So you'll have it readily available. But just in case you didn't, I just wanted to show you how you could go to Google and find the website. All right, so last few things I want to kind of wrap up. Pamela, did that answer your question? Was that where you were going?
Sure. I did. Thank you so much.
Okay, wonderful. All right, awesome. So knowing your credit score is more than half the battle. How are you, not you, just you, Pamela, but anyone that's on here, or even on Facebook, how is everyone tracking their credit?
Oh, Kelly, let me just say this one thing, and I'm
Mhm.
sorry to interrupt you. As
Mhm.
far as credit reports are concerned, When a client calls me and I go into income and debt load and what are you looking for and
Mhm.
what's your comfort level, on a monthly payment, because we can always max you out, but that doesn't mean that's the kind of payment that you want.
Exactly.
I always, of course, have to look at credit.
Mhm.
And when it comes to credit, there's 3 credit scores. And if you're looking at your credit online, those are consumer scores. Those are used if you're going to buy a car, finance furniture, open a credit card, something along those lines. Mortgage reports are scored differently. And you have Experian, TransUnion, Equifax. What I normally do is I do a soft pull. I never do a hard pull until I have a contract, because a hard pull, which of course hits your credit, they're only good for 90 days. And you may or may not find a home within that 90-day period. Or you may find a home, 2 months down the road, and by the time we close, we have to pull a new report. So I do a soft report or soft pull. It doesn't show up on your credit, it has no effect on your credit scores, but it does tell me what your scores are. It gives me your debt load that you're carrying on a monthly basis. And it also gives me, or tells me whether or not we can get your scores increased if need be. So even a soft pull gives us a lot of information.
And a soft pull is important to know the difference between a soft and a hard inquiry, because a hard inquiry doesn't show on your credit, nor does it ding you like point
No, a
wise.
soft pull doesn't show. A
Right.
hard pull shows up big as life.
Yeah. So that's important because when I do connect my clients with Laura, she does do soft pulls, and it doesn't, it gives you an idea of where you are. And she'll tell you exactly what to do without, like, for instance, we had one young lady, I think she reached out to Laura in January, and she needed to do a couple of things. A month later, she came back and her credit score increased by 40 points. So there are so many different things that you can do without having to go out and seek credit repair companies and things of that nature. So certainly keep that in mind with the soft pull. So depending on how you are tracking your credit, you can always pull a free credit report on the freecreditreport.com. Key is here, you're not going to see the actual scores. You're just going to see how accurate everything is reporting, and hopefully everything is. Credit check total is one of the ones that I use to track mine. It's basically, it will allow for you to pull 3 bureaus, and it will allow for you to determine what type of FICO you're looking for. So if you're looking to purchase a car or purchase a home, it shows you each FICO score for each bureau. The credit check total is a little trick to it, because they give you like a 7-day trial for like a day. I'm sorry, for like $1, a 7-day trial for $1. And so you just have to remember to go in and cancel that. Otherwise, they'll end up charging you, I think, like $29.95 or something like that. So remember to do it like immediately. Just pull it, and then, unless you want to keep it, it's totally up to you. Another one that's really good is myfico.com. This one's $39.95 per month. This one comes with the app as well. And that one is really, really accurate. And like credit check total, you can go in and determine your scores based on what you're looking to do. And that one's been spot on for me, at least. So those are just a couple that I would recommend. I think we talked about the 580 minimum credit score for most programs, including USDA. We talked about the USDA loan program. We talked about this slide basically just shows you ways to navigate interest rates. And typically when I created this slide, this was when interest rates were like 8%, like 7-8%. Now they're around 6.5-ish, give or take, just depending on your credit scores. But ultimately, if you're wanting to navigate, a higher interest rate for whatever reason, you can, utilize down payment assistance programs. You can also utilize the 100% loan program like the USDA program that we're talking about now. You can also buy down your rate, which is a fee. Sometimes we're able to get closing costs from sellers that would allow for you to buy your rate down from your lender or with your lender. You can also negotiate that same thing. So we are negotiating, additional costs towards paying down your rate. And then also you can consider new construction homes because most times they do have interest rate plans or interest rates that are available with their preferred lenders that are much lower than what the going rate is. If you're interested in down payment assistance program, and you are in Georgia, the programs, and you are in Georgia, we have Georgia Dream, we have a Cobb County program. We also have City of Atlanta, and Chinoa is another. Typically you'll need a minimum mid score of a 640 credit score. And so the middle score is just basically the middle score of your 3 FICO scores. So if you have a 620, 640, and 660, then we would go with the middle, which was the 640. These down payment assistance programs do have, typically they will have a down payment, they will have a minimum purchase price. So I'm sorry, a maximum purchase price. Yeah. So like for instance, I know with Georgia Dream, I think their max is 350,000, depending on the county, and sometimes less if it's another county that is not one of the major counties. So kind of keep that in mind. They also have maximum income limits, and it does depend on the number of people in your household. And it usually takes a longer time to close these particular loans. I put 45 plus days, but it's leaning more heavily on the plus days. Because I've not closed a down payment assistance program in 45 days. It's been 60 days at least. So another thing that I always like to mention is that a lot of times with down payment assistance programs, I have a lot of people interested in them. But once I explain that that's not just free money that you're not having to pay back one day, a lot of times, some of them are forgiven, but a lot of them aren't. And so what typically happens is that, the down payment that you receive is typically attached to your mortgage as a second mortgage. And when you decide, whenever to sell your home, whoever, company that you went through for your down payment assistance, they likely will get their proceeds back at that time. So if they, if you got 7,500 or 12,500, something like that, when you sell your home, that's going to be paid, and then you'll get the remaining proceeds after that. I have a question. Are there any good ones in Arizona or Colorado? Down payment assistance programs?
Yes.
Okay. That will be a great question for your local realtor. Unfortunately, I service the state of Georgia, so I'm not certain, what exactly is offered there. I would assume USDA is there because it's a, national program. But in regards to, specific ones like Georgia Dream, Cobb County, like these are specific to this state and this particular, in our counties, in our cities. But maybe just reaching out to a local agent, they probably could, help you navigate that. So we talked about USDA. I don't know. I was supposed to update this. It says USA. I forgot the D. USDA. USDA, VA, if you're a veteran, there are 100% financing loans for veterans. There's also 100% FHA loans and 100% conventional loans as well. For USDA, you do have to be in a rural area. When you see 100% financing, that means there is no down payment. This is the link for the eligibility map, but again, I'll email that to all of my registrants. And then we talked about being able to buy your rate down with your lender. Just talk to your lender about that. You always want to negotiate your sales price. So for instance, if you see a home, you love the home just from the photos, but you like, oh God, it's 400,000 and my budget is 350. Wait a little while. Maybe it goes down, maybe they drop it 10 or 15K, and then you know, it's been on the market for 30 plus days. Take your shot, you know? I have another question. If I multiply 29% times of the cost of the home, is that my purchase power? Laura, that may be a question for you.
Yeah, no, it's not 29% of the cost of the home. It's 20. Now, this is only on a refer, a USDA refer loan, not an accept, it's a refer. You would multiply 29% by your total monthly gross income. And that would be what your monthly mortgage payment should be. But that's only on a refer.
So basically, if you applied for a mortgage and Laura put your information in and you received an approved eligible, this wouldn't even be a factor. But if by chance she put your information in and you received a refer, then that's when you would have to have this multiplication thing going on. All right, so new construction, if you're interested in new construction, just be aware that new construction has its pros and cons. Obviously, if you can catch a new construction property before they are past, like, well, if it's at framing, which is where this photo is right here, then you probably have an opportunity to order or specify certain things on the property, you know, like flooring, cabinetry, you know, countertops, things like that. But a lot of times you're kind of just going in and hoping that you like what's already up. Typically, you know, if you are building from scratch, it's gonna take anywhere between 6 to 8 months to completion, and it really depends on, you know, shipment of material and the weather, you know, what kind of weather they're receiving. Other than that, you do typically have great incentives, you know, paid closing costs, upgrade credits, and things of that nature. Obviously, you can pick out your design. I always joke with my clients because, you know, with new construction, you're the first to sit on the toilet. You're the first to use the plumbing. You're the first to, you know, shower, all those things, which has its pros. So, you know, just kind of keep that in mind. There are some new construction 100% or USDA eligible areas because, again, it's based on the area. So if you happen to find a property that is in Carrollton, that is in Villa Rica, that is in, you know, Henry County or Hall, that has new construction. I think there's one that's really trending in Georgia. It's in Forsyth, but I think it's Forsyth. Is it the county or is it Forsyth? I don't know, but it's one that's trending that's under 300,000 that's USDA eligible. I have to find it. And if I find it, I'll put it in a link. But there was one that was trending on social media with, but it's like an hour and a half outside of the Atlanta area. So if you're a remote worker, that could work, right? So when we talk about, here's some extras. So when we talk about your mortgage payment, we don't just talk about just your principal and just your interest. We talk about your principal, your interest, your taxes, and your insurance. A couple things I like to mention is that homeowners insurance is always, HOA. If you've never heard of an HOA, homeowners association, this is important because if you happen to love a property that happens to be in an HOA community, you have to be aware of that because there's fees associated with being in a HOA community. There's also rules that you would have to abide by. And your lender would have to consider those HOA fees when qualifying you for a specific home as well. So kind of be mindful of that. And then traditionally, sellers would, well, I'll say this, listing agents would typically share their commission with the buyer's agent. Typically, that's how buyer's agents are paid, or was how buyer's agents were paid. So it will ultimately depend on your seller of the property, whether that's a builder or whether it's a homeowner that's selling a property that's for resale. If they are willing to pay your buyer's agent, then that's how your buyer's agent is paid. If they're not willing to pay your buyer's agent, then you have to be prepared to pay your buyer's agent. Okay. So your agent should be having that conversation with you up front about those fees. So it shouldn't be, something that's coming up days before closing. You should already know, okay, the seller isn't paying my agent. I have to, be prepared for those fees. They should have that conversation with you. They should already have that in writing with you. Any questions? I do have one. All right. So I can get a house built if approved from a USDA loan. Okay. So with USDA, it does, Laura, with USDA. So, Kimberly, if you are purchasing a property from an area, I'm sorry, from a builder that's currently building a subdivision in a USDA eligible area, then yes, you can have a home built using a USDA loan. Now, if you are buying land and if you are hiring contractors to purchase, to build, I'm like 99% sure that wouldn't be an option. Laura, you want to chime in?
It could be an option. Um, it would be a 2-time close is what it would be. So the final loan, as long as it's in a USDA area, we would close it under a USDA loan.
Okay.
The builder would hopefully have his own line of credit, that type of thing. And then we would do the permanent financing, USDA.
Okay. Also, in regards to the past 2 years of tax filing, what exactly are they looking for?
Just federal.
They're looking for whether or not you owe, your
Well,
income.
definitely whether or not you owe. And if you owe, then you need to have a payment plan in place for that. But what they're looking at W-2s, do the W-2s match what's being reported to the IRS? We also pull tax transcripts to make sure all of that matches as well.
Okay. All right. Any other questions here?
One last
We're-
question I
we're
did
actually-
have. What about so do they, is it penalized against you? Like say so I have previous gambling winnings, right? Pretty large gambling winnings, a couple years back. And 2 of those winnings, they weren't paid. So like, how would that kind of go into it? Because I know that, that's something that shows on my report is I have gambling winnings.
Were they reported on your tax returns?
So they're gonna be,
Okay, well, unless you're a professional gambler, that would be looked at, for example, like a one-time thing. It's not, your standard source of income.
Right. Okay. So they're not gonna hold the fact that I have, $18,000 gambling winning, right? And none of it's been paid back. Is that something that's going to hurt me?
What do you mean none of it's been paid back? That you haven't claimed it on your returns?
Yeah, like, so I haven't filed my taxes just yet, but that's what I'm saying. I'm going to be here in the next few days, actually. But when I go ahead and I file, because I haven't paid any of those taxes back. So hopefully when I file my taxes, they're gonna, of course, keep what I owe.
Right, they gave you a 1099? Is that what they gave you for these winnings?
No, they didn't even give me anything. I mean, they just gave me the money, and even when you ask them if they can just hold on to the money or keep the taxes, they didn't want to do it for me.
Oh, because typically they would issue a 1099 that you would report on your tax returns. Now,
Okay.
you can also, I mean, granted, you have to, if they do that, you have to claim your gambling winnings, but you can also claim gambling losses.
Correct. Yeah, that's why it's good to use a card.
So
But
that
no,
might be a
it's-
great question for her tax professional.
Yeah. But as far as qualifying for the loan, I mean, do you have gambling winnings that you claim every year?
Every year, I'm sure. Yeah, I do.
Okay, what they might do in a case like that is average it.
Okay.
You know, so for example, if it was 5,000 one year and, 18,000 last year, they would probably average that.
And then
Because
that would
it's
be that wouldn't be so that they wouldn't use that as like my annual income though, right? Or
no,
would they? Okay.
no.
Okay.
Mm-mm.
Because it's not consistent, correct?
It's variable, right?
Okay. And what if being like self-employed? Like how could you get approved for a
Okay,
loan if you're self-employed?
all right, being self-employed, again, we take now whether or not you're incorporated or if you're a sole proprietor, or if you're incorporated, are you filing corporate returns? And if that's the case, we need 2 years of personal and 2 years of corporate returns. If you're filing just a Schedule C, just straight run-of-the-mill self-employment, we still take a 2-year average. Now, we add back, mileage is a big add back, depreciation, business use of home, that type of thing. We add those back to offset expenses. So it's a deduction for you and it's an add back for us. That's if you're filing a Schedule C. So for example, if you have a hair salon or you're renting a booth, you would undoubtedly file a Schedule C and you would write off supplies and rental and, this, that, and the other thing. But if you are self-employed, just keep in mind mileage is a big add back for us, a big deduction for you, and depreciation as well, business use of home. And you can always claim business use of home if you're on your computer doing a little bit of work or whatever, and it goes by square footage of whatever room you use when you're working at home.
All right, perfect. Thank you for answering that.
All right. Well, we're actually going to wrap up. Let me see. Oh, yeah. So this is my contact information. This is Laura's contact information. If anyone has any additional questions, again, tomorrow morning, I should be sending out the replay for today. The webinar will be on my YouTube and I'll send the link. And then I will also include the USDA eligibility map. I'll also have a survey attached to give us some feedback based on your experience so that we can improve and get better moving forward. And so thank you all for attending. It is 7:34. We wrapped up in about an hour and a half. So if you have any questions, feel free to stay back. I'm going to discontinue our Facebook share. And I will go ahead and cancel and turn off my recording here. But thank you all for coming. It was great.
Thank you. Such good information.
Awesome. That's what we love to hear.